What if you put $500 a month into investments for the next 20 years? How much could that actually turn into by the end? A lot of people look at that number and think it's too small to matter. They figure you need to invest thousands every month, or already have a big chunk of money saved up before it's worth doing. But the truth is, the amount you start with is often less important than how consistently you do it and how long you let it grow. In this video, we're going to look at the actual numbers behind investing $500 a month for 20 years. We'll keep it simple, clear, and realistic. No hype. Just the math and what it could mean for you. Here's the basic idea behind why this works. Every single month, you put $500 into an investment account. That money then gets invested in something like a broad stock market index fund. Over time, two things are happening at the same time. You're adding fresh money every month, and the money that's already in the account is earning returns. Those returns then start earning their own returns. That's what people mean when they talk about compounding. It's a little like planting a tree. At first you don't see much happening, but if you keep watering it and give it enough time, it eventually grows into something much bigger than what you originally put in the ground. The same thing happens with money when you give it enough time and keep adding to it regularly. Let's look at the actual numbers so you can see what this could look like. We're going to assume you invest $500 at the end of every month for exactly 20 years. That's 240 monthly contributions in total. If you add all of that up, the total amount you put in yourself comes to $120,000. Now, the final amount depends heavily on what kind of average annual return you earn. We're going to look at 3 different scenarios, so you can see how much the rate of return actually matters over a long period like this. At a conservative 7% average annual return, the account would grow to approximately $260,463. At 8% average annual return, it would reach about $294,510. And at 10% average annual return, which is closer to the long-term historical average for the stock market, you're looking at roughly $379,684. These are hypothetical examples. They're calculated using standard compound interest formulas with monthly contributions and monthly compounding. In real life, the market doesn't return the same percentage every single year. Some years are much higher, and some years can be negative. But over long periods of time, these averages give us a reasonable way to think about what's possible. Let's break down what these numbers actually mean in plain terms. Take the 7% scenario. You put in $120,000 over 20 years. At the end, the account is worth $260,463. That means the growth, or the money the investments earned for you, added up to about $140,000. You more than doubled the total amount you contributed. And you didn't have to do anything extra after setting up the automatic investments. Now look at the 10% scenario. You still only put in the same $120,000. But this time, the account grows to $379,684. That's almost $260,000 in growth on top of what you contributed. Your money nearly tripled. The difference between 7% and 10% over 20 years is more than $119,000. That's a huge gap, and it comes entirely from the higher average rate of return working on your money for a long time. Even small differences in return can add up to very large differences when you give them 20 years to compound. It's also worth noticing that a big portion of the growth happens in the second half of the 20-year period. The early years feel slower because there's less money in the account to earn returns. But as the balance grows, the same percentage return starts producing bigger dollar amounts each year. That's the snowball effect of compounding in action. Now let's compare this to what would happen if you didn't invest the money at all and just saved it instead. If you put $500 a month into a high-yield savings account, earning around 2% interest, after 20 years, you would have approximately $147,400. That's still better than doing nothing, because at least you earned some interest. But it's dramatically less than even the conservative 7% investing scenario. If your money earned basically zero interest, like if it was sitting in a regular checking account or literally kept in cash, you would end up with exactly $120,000. No growth at all, just the money you originally set aside. The gap between saving and investing becomes very clear over a 20-year period. In the 7% investing example, you end up with more than $113,000 extra compared to the 2% savings example. And you didn't have to save any additional money each month to get that result. The difference came from where the money was working and how long it had to grow. Of course, investing comes with risk that a savings account doesn't have. The stock market can go down, sometimes significantly, and stay down for a while. That's why these numbers assume you're investing money you won't need for at least 20 years and that you're able to stay invested even when the market is volatile. So, what are the real takeaways from all of this? The first one is that consistency beats almost everything else. $500 a month might not feel like a lot when you look at it 1 month at a time. But when you do it every single month for 20 years without skipping, it adds up to serious money. The key is making it automatic so you don't have to think about it every month. The second takeaway is that time is doing most of the heavy lifting. The longer your money stays invested in compounding, the more powerful it becomes. Starting even 5 or 10 years earlier can make an enormous difference in the final amount, which is why it's often better to start small now than to wait until you feel like you can invest more later. The third takeaway is that the rate of return really does matter over long periods. Moving from 7% to 10% added well over $100,000 in our example. That's why it's worth paying attention to fees and choosing low-cost investments, because high fees can quietly eat into your returns year after year. The fourth takeaway is that this is not guaranteed and it's not risk-free. These numbers are based on average returns, but actual returns will be different every year. There will be good years and bad years. The strategy only works if you can stay invested for the full period and not panic and sell when the market drops. And the fifth takeaway is that where you invest the money matters too. Using tax-advantaged accounts like a Roth IRA, traditional IRA, or 401k can make these numbers even better because you keep more of the growth instead of giving a portion of it to taxes. Low-cost index funds also help because they keep fees from taking a big bite out of your returns over time. If this video helped you see how powerful, consistent, long-term investing can be, even with relatively small monthly amounts, then that's exactly what I was hoping for. The math is pretty straightforward once you see it laid out. Small amounts invested regularly over many years can grow into something meaningful, but none of it happens if you don't actually start. The hardest part for most people is simply beginning and then staying consistent over time. If you're thinking about getting started, the simplest next step is usually to open an investment account. If you don't already have one, set up an automatic transfer for the amount you're comfortable with, and choose a low-cost, broad market index fund. Then you can let time and compounding do the rest of the work. If this kind of clear, no-hype breakdown was helpful to you, I'd really appreciate it if you gave the video a thumbs up. It helps more people find it. And if you want to see more videos like this that explain how money and investing actually work in plain English, go ahead and subscribe. Feel free to drop a comment below and let me know how much you're currently investing each month or what's been holding you back from starting. I read pretty much every comment and I always appreciate hearing from you. Just remember, this video is for educational purposes only and is not personalized financial advice. Everyone's situation is different, and investing in the stock market involves risk, including the possible loss of principal. These are hypothetical examples only. It's always a good idea to do your own research or speak with a qualified financial professional before making decisions with your money. Thanks so much for watching all the way through. I hope this gave you a clearer picture of what's possible. I'll see you in the next video.